Good evening, friends. I welcome all of you for the 16th knowledge sharing webinar of corporate professional. We are doing multi-facet program on different topics, different subjects by inviting distinguished speakers. And today we have selected the very interesting topic, a distinct approach to capital investment, alternative investment fund. That's called AIF. Friends, as you are aware, this is a very interesting and the new tool which is slowly popularizing and taking a shape, and industry is accepting and the investors are also accepting. Today's program, we want to discuss the reason for growth of AIF as a preferred tool for capital investment, what distinguishes AIF from other collective investment tool, what are the benefits of the AIF route, and analyzing the AIF structure and the modes of investment. Now, this particular topic is a new topic for investors' point of view and the point of view of those who are investing in the collective investment scheme. Friends, today this program which we are organizing, we have invited a very learned speaker, and first starting with Dr. Ruchi Chojar. She is CGM SEBI and she is the in charge of AIF. She has a very distinguished career in Securities Exchange Board of India. She has worked in various departments of capital market. She was in the takeover division, various market regulatory division, and now she is the CGM of the alternative investment division. Dr. Ruchi Chojar will join us shortly. She is in the meeting in SEBI going on, and she will join us. Then we have our second learned speaker, Mr. Arvind Mathur. He is a very renowned name in this industry. He is a CFA and FRM. He is the chairman of Private Equity Pro Partner. And Arvind sir has a distinguished career, and he has established more than 30 private equity fund in Asia Development Bank, Manila, where he had the private equity. And while he was in Citibank, he helped raise 1 billion India Infrastructure Fund. Mr. Mathur was in the committee of the Alternative Investment Fund, which SEBI has started this process under the chairmanship of Narayan Murthy, and he was instrumental for 3 major reports of reforms needed to grow alternative investment fund in India. Mr. Mathur has closely worked in number of institutional investors or those who are in alternative investment funds such as GIC, CalPERS, CDPQ, AIG, and Prudential Insurance Company, and Employee Provident Fund Malaysia, ADAI. Mr. Mathur has worked in MNC in various M&A activity, delivered lectures on private equity, and he has given a various lecture in Harvard Business School and various AIF and private equity and M&A training program in many countries. We welcome Mr. Mathur, and he is the very right choice for this program, who has knowledge of in and outs of this particular subject. Then we have another distinguished speaker, Mr. Arvind Lalla. He is a domestic institutional client group Edelweiss. He is having a 15 years experience. Professionally, he's a chartered accountant. He heads the domestic sale of Edelweiss asset service of PMS and AIF service. He has worked in IIFL, Kotak Securities, and various other companies. He is a well-rounded professional who knows in and outs of this particular thing. He will discuss with us about the custodial role and accounting process. Then we have a Deepika Vijay Sani. She is a partner in corporate profession, looks after the security law and transaction advisory. She has an experience of 20 years, and she is part of this security law department and heading that. And she has worked and she was instrumental to form various AIF, advising various AIF and various funds when it was there. So we have this four persons distinguished speaker group, which we'll discuss with all of you. Now, friends, as you are aware, that collective investment tool is a part of Indian DNA. If you just see that part, that what is happening in India, the collective investment is a one problem in India, and it is not a new concept. Everywhere we have seen that people were collecting investment through CIS scheme, through chit fund, or through various means. And we have seen that also in the collective investment scheme, people were cheating the poor investors. And that's why the investor lost a lot of money in CIS scheme, which is known to us. Now, various scheme when they were floated, the government was worried. Then they came out with various rules, regulation of collective investment scheme. And then simultaneously, SEBI was working on various development and how they can mature this market and how they can do something great for this particular thing, so the people can take maximum advantage of this particular new concept. Friends, today when we see the distinct approach of capital investment or alternative investment fund, I just want to share with all of you my overview that this collective investment scheme, we should understand one part, that this part is that collective investment tool has three types of structure. One is it has a money tool where mutual fund, FVCI, FPI, portfolio managers, and AIF invest money. Then we have a asset tool, that's REIT and InvIT. That is the new concept SEBI has brought out. And we have seen the, no doubt, REIT, only one REIT has come, that is Embassy. And then InvIT 6 and 7 InvIT has come, which is dedicating for infrastructure fund. REIT is for real estate. Then we have a collective investment scheme CIS, where which is hybrid, where the asset as well as money both can be pooled, and that is the new concept has come after the SEBI's strict action against various CIS scheme which was misuse the investors fund. Now, if you see the major influencer of this collective investment scheme is that they channelize the idle money which people are not investing in market by different means. Better funding options are there because they can fund different types of instrument. Trustworthy avenue, decrease in the viability of debt funding because debt fund is not available to everybody. It's a easy fund, and the less regulated investment regime, that is also there because this is not so tough as compared to other process. Like if you want to bring IPO in the company, you will find that IPO process is not so easy. And then liquidity crunch. Now, and during the COVID time, lots of issues there related to IPO, related to liquidity, which is happening. So this particular thing is a major influential where the collective investment tool is popularizing. Now, what is AIF? AIF is a privately pooled investment vehicle which collects funds from investors for investing in accordance with the defined investment policy for the benefits of investors. So this is privately pooled investment. They have a defined investment policy, and then it is for the benefit of the investor. We have seen KKR, Blackstone, India Alternative, SN Capital, various fund, they formed AI in the form of AIF. And if you see the AIF structure, the SEBI has venture capital regulation, which was introduced in 1996. And that was the encouraged funding to by entrepreneur in early stage companies in India. But after some time, when venture capital fund was there, but it has some restriction. So in 2012, SEBI has replaced with this because that fund has venture capital fund has some restriction. So they brought out and replaced with the venture capital fund with new model AIF in 2012 with various flexibility, various particular different types of structure. And then growth of AIF from 2012 to 2020, we have seen the AIF shown a tremendous growth since its introduction. Number of AIF now is 118, and this total AUM is 1,42,000 crore rupees. That is there. You can see the growth. How this AIF works? The AIF works. We have first there is a sponsor. Then a sponsor identified which form they will form the fund. The form can be the AIF can be formed in trust form, in a company form, in LLP or body corporate, and then they will appoint a manager who will look after the AIF fund. They will collect money from the investors, those called unit holder, and then they will appoint a trustee that they will do oversee the body which is looking after the fund, and then they will invest fund in the investee company for getting return for their investor. So this is the AIF structure, which Deepika will explain to you in detail. Then how the money you can take. So flow of money in AIF comes from NRI, Indian citizen, and foreign investor. That is a relaxation. All can give money. It can come in the form of trust, company, LLP, and body corporate, any thing you can form. And then this money you can invest. The money can be invested because AIF has three categories. First category is, second category, and third category. First category is startup of all sector, infrastructure fund, real estate you can invest, economically and socially desirable sector area, social sector, that is a very innovative things which is there in the category 1. Then category 2 has majority investment in equity and debt instrument of unlisted company. That is important. Their majority fund has to invest in unlisted fund. Minority they can list in they can invest in unlisted company. Unit of other than category 1 and category 2 AIF, they can also invest. Then third category, which is a larger, where the fund can be invested in listed, unlisted equity, debt instrument, derivatives, commodity, and this way the SEBI has designed the three category of the AIF. Now, if you see the AIF, I have explained to you there are three types of AIF: money-based AIF, asset-based AIF, and hybrid-based. So the comparative, you see the pooling of funds. So AIF is the winning in all aspects. Pooling of fund AIF can do, PMS cannot do. Can be established any form, company, trust, LLP, body corporate. That is another interesting aspect. PMS, RIT, CIS, and FPI cannot do this. Tax benefit, that is very important, which is the winning point for the AIF, that they pass through status. Here the investor invest money in the pool, but the tax is only on a one hand, that is the investor's hand. That is the one biggest advantage to AIF, which is not available to mutual fund, the PMA, the RIT, and the CIS and FPI. Then relaxed regulatory regime, that is there. And one interesting aspect also, that the interesting aspect is the NBFC. So NBFC is also there, because sometimes people think that I'm also pooling in a different way. So I have just given a comparison of NBFC also. So relaxed regulatory regime. The regulatory regime is relaxed here. It is not very tough. Leveraging, yes, AIF can do leveraging. Only NBFC can do leveraging. All other the tool cannot do. Leveraging means they can take the loan, but only category 3 is allowed to take the loan. That is 2 times of their net worth. So that is net asset value. They can take 2 times. Then availability of multiple investment instrument. The AIF provide, you can invest in commodity, you can invest in listed, unlisted, and the social sector, real estate, infrastructure, and in your own AIF you can invest. Then foreign investment under automatic route, that is also interesting. There is no need to take specific approval. Direct you can invest in the foreign investment route can be there. That is a very big advantage which we are not finding other than RIT and InvIT. So these are the advantages of the AIF. Then come to the point of that what is the cumulative net figure as on 31st December. So the most popular category is category 2 because it has a flexibility. It can invest listed or unlisted both. Category 1 is there, but it is not that popular. That's category 2, and the category 3 is there. That is so category 2 is most popular. Category 3 is number 2, and category 1 is number 3 as per this particular thing. And they have invested. They have raised, commitment raised, and the fundraise and the investment made by this grade they have done. So this is all three types of AIF which has done. Now if you see the category 1 division, so the infrastructure fund they have invested, social venture fund, venture capital fund, and SME fund. So they have invested in this way. So you can see the venture capital fund is more popular in category 1 process. Now, if you see the growth in 2012 and 13, number of AIF registered 42, 101, 135, and then slowly every year 100. And now you have seen 400 to 600, now 780, and now it has reached to 800 and 818 that has reached. So now today up to 29 July 20, this number has reached to 818. Then cumulative investment amount that is also there. That if you see this, the fund is which they have raised fund from 3,000 to it has reached to 1,42,000 crore rupees in as per SEBI website. So you will see these are the growth pattern. Now, what are the reason of growth of AIF? First is relaxed regulatory regime, because it's a you can form any structure. You can regulatory regime is also not very strict. It's relaxed. Like CIS, it is very tough, so nobody has registered. The tax benefit is there because category 1 and 2 AIF can take a state through. They can take advantage tax pass through status, but category 3 is not allowed. Then easy foreign investment. Foreign investment can directly invest, and it is automatic route. No need of FDI sectoral cap is also required. Then diversified, you can invest in various mode. That is also one advantage, and reduce operational cost. Cost of AIF is also reduced. Now, these are the reason of growth. Now, we have to understand that why there are some issues which we will raise before the other speakers also. One is taxation issue. Taxation is allowed only for pass-through status for category 1 and 2. Category 3 is not allowed. So that is there, and I will request Mr. Mathur also to take up this, discuss this issue. Then second is performance benchmark. Now today, when I was just thinking that I have to take some data and give it to our audience today, that in which area the performance benchmark of which AIF is better. The SEBI has passed a circular of 5th February 2020 performance benchmark, but it has to take place. So like equity share, you can see which AIF has performed in which way. Like mutual fund is there, their NAV value is there, so they should come, and you can have a various parameter, comparable parameter should be there. SEBI has given the complete roadmap, but it has to come in a shape. Then third is prevention of manipulation and fraud. Now this is a new instrument, no doubt, and it is taking shape, but the problem is the manipulation can take place. The ticket size is 1 crore for investor that people do manipulate. That is also because they want that big investor should come. Tenure is open-ended and close-ended, and that is the issue, that whether this they can extend. If the close-ended there, they can extend this. So tenure is one issue. Then investment other than the primary object for which they have formed, that is also there. Then a monopoly of big investor, because SEBI has restricted that you cannot invest particular amount in one group, like 25% and 10% they have given. So, but we have seen that some big investors, they monopolize and they dictate the certain things which should not be there. Then popularization of AIF should also be there, because various people are not aware, they are confused that what is the AIF, how to do it. That's why the big number is there, but people, investor is not aware of this thing. And second is listed and AIF. Listing is allowed, but listed AIF is not. Single listed AIF is there, so that has to be popularized. That what it should not be there. The next is the promotion of social venture fund. This unique fund should be promoted both for Indian scenario, and now the CSR has come in India, and the CSR can be utilized through this promotion of this social venture. Some combination can take place in this structure. So these are the issue which AIF is facing, and I have given the overview. And now I will request Deepika to take up the next part, that what is AIF, how the AIF works, what are the process, how the AIF can take place. All these things that Deepika can discuss, and Deepika can explain the entire process of AIF and how the SEBI is looking after, how the SEBI taking a point of view. So everything. So now over to Deepika. You can cover your point. You can share your points, and whatever issues I have raised, Mr. Mathur and Ruchi Madam can cover when they will discuss their part. So over to you, Deepika. Your voice is not.
My screen is visible?
Yeah.
Am I able?
Yes, the screen is visible. Okay.
Okay.
Slide share पे कर लो, बड़ा कर लो इसको.
Now is it okay?
Yeah, नहीं उसको slide बड़ा कर लो, slide show पे.
Just a second. Is it okay now? I'm not able to see that actually.
Slide share is not coming. Slide share is coming, but it is. दीपका आ गया वो देखना अभी. या यस या कैरी ऑन.
Good evening, friends. So today, as Mr. Vijay just said, we are discussing a distinct topic wherein we are taking a very specialized investment tools under discussion, which is AIFs. We have already seen the structure of an AIF, how AIF is basically a pooled investment fund wherein this fund collects in various funds from distinct investors. The fund in itself is created by a sponsor, and there is a fund manager who manages the investment. Basically, fund manager decides upon the decision, decides upon where the fund has to be deployed. There is a trustee which is appointed in case if a fund is registered in a form of a trust. And then we have various investment tools wherein we deploy our investments. So this is how a fund structure look like. Investors earns the returns which are earned by an AIF through its investments, and fund manager and trustee get their fees in return. Now, how and in what form can I register my AIF? So SEBI provision is allowing all three options to register a fund, that is trust, company as well as LLP. Now, how to decide as to which is the best option for me? So there are various basic parameters which I'm just broadly taking you through. So just to give you a market scenario, trust is the most favored market scenario because it is an internationally accepted tool, and until date, most of the AIFs in India are also registered as trust. There are few LLPs, but negligible companies which are registered as AIFs. Investors also preferred a trust route because trust, as I said, is an internationally accepted mechanism. Trust has more confidentiality with respect to the investors. Which company provides least because of so many disclosures which a company is required to make? An LLP has a moderate level of disclosure requirement. When we come on to the legal compliances, we all know that company has a lot of compliances to do, and LLP simultaneously have similar level of compliances which are required to be done. And trust has minimum compliances under the law. Ease of business, again, trust is enjoying majority of the maximum ease of business as compared to other two structures. So that is why, considering all these factors, trust is a favored option. Also, from a taxation perspective, trust is preferred. Now, what is an AIF? What are the requirements and various features with respect to AIF? So, when we register an AIF in any of the category, the maximum number of investors from whom we can raise funds is 1,000. So, you can have up to 1,000 number of investors in an AIF. There is another category of AIF which is angel investor. In that, there is a limit of 200 investors, but for all other categories, there's 1,000 is a maximum limit. How much an investor can deploy fund in the in an AIF? So maximum there's no limit, but minimum 1 crore requirement is there with respect to one investor, each investor, where they can have joint investment through, say, within a family, father and son, husband and wife, brother and sister. So that is the only joint category which is allowed. But the investment size has to be 1 crore in total. So this shows that AIFs are for high net investors only. For angel fund, there is a minimum requirement of 25 lakh rupees. What is the minimum corpus? So an AIF which is registered can start deploying funds only when it has obtained a minimum corpus size of 20 crores. And until it reaches that corpus size, it cannot start deploying the funds. In case of angel fund, it is 5 crores. Fundraising, how can an AIF raise funds? It is only through private placement. There cannot be any issue or public invitation for fundraising. I can have several, I can have more than one schemes in one AIF. So it has to be through private placement. Number of schemes, I can have any number. Who can be an investor in AIF? It can be any person who's having a investment capacity of more than 1 crore. He can be Indian investor, he can be a foreign national or a non-resident. Now, what is the requirement of investment by the sponsor and the manager? So for an investor, it is 1 crore, but for a sponsor or a manager, it is 2.5% of the corpus size or 5 crores, whichever is lower. So there's no 1 crore limit for them. It's 2.5 of the corpus or 5 crore, whichever is lower. In case of angel fund, it is 5% of the corpus or 10 crore lower or 2. Sorry, in case of category 3, the manager or the sponsor has to deploy higher fund, which is 5% of the corpus size or 10 crore, whichever is lower of the two. Now, I've been talking about categories of AIF, but it is also essential to understand that what do you mean by these categories? So basically, earlier before the promulgation of these AIF regulations, there was only one fund which used to be registered with SEBI, that is venture capital fund. We have all heard about these venture capitals. But when SEBI came out with these AIFs, it categorized the fund in 3 categories. Category 1 is essentially a venture capital fund or there are other categories introduced in the same category, which are like social fund, SME fund, infrastructure fund. So all these are covered in category 1. When we talk about angel funds are also covered under category 1, but they have altogether different kind of requirements under the law, which we'll deal separately. Category 3 is most say stringent and most complex nature of fund, which are dealing in listed securities, derivatives, hedging, etc. So if you propose to have your investments in listed companies, in hedge funds, etc., then category 3 is the category which we look for. Now, category 2 is a residual fund. That is why I took category 3 first. So anything which is not covered in category 1 and category 2 is covered in category 2. Also, category 2 provides most flexibility as well in terms of what kind of a scheme structure I need, what kind of investment deployment I propose. So on these basis, we have categorized, SEBI has categorized 3 categories for an AIF. Now, dealing with each category separately. So what are the requirements in case of category 1? Deployment of funds, primarily investments in unlisted entities, startups, unit of AIF category 1. So the funds which are raised by category 1 AIF, they can be deployed in their respective categories of unlisted entities, startups, and units of other categories of AIF 1, other AIFs of category 1 only. They are not allowed to have any kind of a borrowing or to have leverage. It has to be a close-ended scheme. The tenure of the scheme minimum requirement is 3 years. You can extend it up to 2 years further with the approval of your existing investors. When we go in for the registration fees of SEBI is 5 lakhs. Number of projects we can have. So what does number of project means? That is that you can have your total fund size out of your total investable corpus. You can only invest 25% of your total corpus in one project. So if I have a corpus size of 100 crores, I cannot invest 25 crore, more than 25 crores in one target company or one project. So the purpose of this is to have a proper balancing of your risk. Now coming on to the other category, that is angel fund. So angel fund is basically introduced later and it is to benefit small investors and small investee companies. So deployment of these funds can only happen in those undertakings which are, or venture undertakings, which have not been incorporated for more than 3 years and which has a turnover of less than 25 crores. So for an angel fund to invest in an angel entity, that entity has to be not more than 3 years old and should not have been invested, should not have a turnover of more than 25 crores. And the maximum investment which an angel fund can do in an angel entity is 50 lakhs or up to a maximum of 5 crores. There's no such amount restriction in case of other categories of fund, but here there's an amount restriction along with the same restriction that 25% of your corpus cannot be deployed in one project. Now, what are the other conditions which are different from category 1? Minimum corpus, I can have 5, it was earlier 10 crores, but now reduced to 5 crores. Minimum investment by an investor, we have already discussed 25 lakhs, which for other funds it's 1 crore. Approval of investor before. So now this is very important condition for an angel fund. When an angel fund is registered and it proposed to make any investment in any project, for each investment it has to take approval of all the investors. It is all the investors. Approval is must for making an investment. So if I have identified a project that I want to get myself registered, sorry, if I'm I have an option that I propose that I want to make an investment in a particular project, I have to get the approval of all my investors before deploying my fund in that project. With each of the investment, I have to file a term sheet with SEBI. So angel fund is a little more secure kind of a fund, and SEBI is also having more more reporting requirements in case of angel funds, considering the size of the investments of the angel investors. Coming on to category 2, as I said, category 2 is most flexible. So in case of deployment of fund, you can have it majorly deployment requirement is that you deploy in unlisted securities. But then you simultaneously you have a flexibility to have investment in even listed securities. So I can have a structure wherein 51 I'm doing in 51% of my corpus I'm investing in unlisted and 49 in my listed category or listed companies. Then I have a flexibility of going in for the debt fund or equity fund or a combination of debt and equity. Borrowing and leverage is not allowed even in category 2. It is again a close-ended fund. Registration fees here is 10 lakh rupees, which is in category 1 is 5 lakhs and angel fund 2 lakhs. Project number of project or percentage of corpus is 25 here again. That means I cannot deploy more than 25% of my fund investable corpus in one project. Tenure here again it is 3 plus 2. Category 3. Now category 3 can be an open-ended fund or a close-ended depending upon the fund. Then deployment of fund can be in securities of listed or unlisted company, derivative complex or structured projects, units of category 1 and category 2. Also, SEBI has now allowed investments in commodity derivatives as well up to a certain limit. Leverage is allowed subject to the consent from from their investors. Maximum limit which SEBI has provided. Category 3 are mandatory to have custodian as well. Also, like in case of category 1 and category 2, custodian is not mandatory. It is needed only when your corpus size increases 500 crores. But in category 3, from day one, there's a requirement of custodian. Registration fees is 15 lakhs in case of category 3. Now, what are the general these were these till now what we were discussing were category specific requirements. Coming on to the general investment conditions which are there, which are applicable to all kind of categories. One is investment in securities of foreign companies allowed subject to condition imposed by AIF. So an AIF is also allowed to invest in foreign securities, but there are restrictions which we are dealing in the other in the slide later. Uninvested investable fund may be invested in liquid mutual funds or other liquid assets like treasury bills, commercial papers, etc. So if I have a corpus ready with me, but I'm not having any investment opportunity, and that corpus is lying idle. So in all the 3 categories, I have an option to invest them in liquid mutual funds or other liquid assets like treasury bills, etc. Manager or sponsor shall disclose their investment in the alternate investment. So we have the fund manager and the sponsor of AIF has to disclose their investment. There is also a requirement that if you propose to invest in your associated entity, so sponsor has its own company or it has a interest in any of the company wherein AIF proposed to invest funds, then the approval of 75% of the investors will be needed before deploying that. And the terms of such investment cannot be favorable than the other to the wherein the other investment I'm making. So these are the general investment conditions which are applicable. Now, what are the eligibility requirements to be registered as an AIF? So your charter document, which means a trust deed or an LLP deed or your article, should allow or permit you to be registered as AIF. This document or chartered, so this document has to be registered as well. So if I have a trust, my trust deed should be registered, my LLP deed should also be registered, and my company has to be registered. Your charter document must necessarily restrict you from making invitations to public, applicant, sponsor, and manager. All three entities should be fit and proper as per SEBI fit and proper regulations. Key investment team should have one person with experience of 5 years in capital market and fund management. Manager and sponsor should have necessary manpower. So there has to be proper infrastructure, manpower with adequate qualifications and knowledge. How do you register a AIF? To register an AIF, you as on date, SEBI has provided an online portal. There's no documents which have to be filed physically, but through this online portal. At the time of application, you have to make a payment of 1 lakh rupees, which is non-refundable application fees. On making this payment, we receive a login ID and the password. On receiving this login ID and password, we have to upload Form A, which is a form prescribed by SEBI for making an application for AIF. We have to file a private placement memorandum, which has to be drafted in terms with the requirements of SEBI, which is already provided in the regulations, and we'll discuss it subsequently. And all other requisite documents like your charter document like trust deed or LLP deed, etc. These documents are verified by SEBI, and then SEBI generally, if SEBI has any kind of queries, they ask you those queries through emails. SEBI generally take 2 to 3 months to give you registration. Registration is received online, and then physical delivery of registration intimation comes online, and then we get our registration certificate. So this is a snapshot of how the whole registration process goes. Now, what are the requirements of a private placement memorandum? Because private placement memorandum is a document which you take to each investor for raising fund. So it is very important that a true and fair disclosure with respect to your scheme, with respect to what will be the expenses, how you propose to manage the fund, etc., is given to the investors. So these are the contents of private placement memorandum: investment objective, strategy, and process. So what do you propose to do with your fund? Where do you propose to invest? What is your investment objective, and what is the strategy you propose to have? Market opportunity, Indian economy, industry outlook. These are the general scenario about the sector, etc., wherein you propose to deploy your funds. What will be your scheme structure, governance structure? What kind of committees you'll have? Who will be making the decision, etc. Track record of the manager. Principal terms of the fund or scheme. Principle of portfolio value. How will you be valuing the various projects or investments wherein you propose to make investments? How will you manage your conflict of interest? What are the possible risk factors? Legal, regulatory, and tax considerations which will be applicable to you as a fund. You have to give a very clear-cut illustration of fees, expenses, and other charges. So what fees you will be charging, what profit sharing will you be doing with the investors, how much, whether you will be retaining any kind of a profit, what other expenses or charges which you will be sharing with other entities. Like if we have a custodian, we have to pay some fees to custodian. If we have trustee and a professional trustee, we have to make payments to those trustees. So this expense chart has to be very clearly depicted in the private placement memorandum. Distribution waterfall, that when you will be getting any returns, how that will be distributed, who will be paid first, what expenses will be deducted first. This is also very important and required to be properly illustrated. And then there comes the disciplinary history about the fund, about the sponsor, and about the manager. Then there are other supplementary disclosures which an investment manager can disclose as per his own discretion. So I'm especially covering foreign investment as a separate discussion here, because there's a lot of queries which we face in a regular parlance, that whether a foreign investment is allowed in AIF. So the answer is yes. 100% 100% FDI is permitted AIF, and there is no permission which is needed. It's under automatic rule. If a sponsor and manager, so AIF can also be promoted and managed by foreign entities in India or by the Indian entities. If the sponsor and manager are both owned and controlled by Indian entities, then AIF is deemed to be an Indian AIF, and investments further made by these AIFs are not covered under the downstream FDI downstream investment requirements. That means that even for a fund which is controlled and owned by an Indian entity, but all the fund money has come from foreign investors, then also any investment which is being made by this fund will not be treated as an FDI. No requirements of FDI limits and pricing guidelines will apply. So this is a very has given really good boost to the AIFs. Then the extent of foreign investment in corpus of an AIF will not be in case of category 3, there is a restriction that if a portfolio investment is that category 3 can make portfolio investment in only those securities of instruments in which FPI is allowed as per FEMA regulations. So for category 1 and category 2, there is no restriction. Category 3, there is no restriction with respect to how many number of foreign investor can be there. But even if a single foreign investor is there in an AIF, which is a category 3 AIF, then for deployment of fund, you can only make in portfolio investment in those securities which are allowed for an FPI under FEMA regulations. Downstream investments by AIF, that which is treated as foreign investment, based upon its management, shall have to conform to the sectoral caps and condition restriction, if any, as applicable to company in which the downstream investment is made. So, as I said before, if your control and ownership is with a foreign entity, then downstream investment requirements will apply. If it is not, then they will not apply. So another question is whether an AIF can invest in foreign securities outside India. So here also the answer is yes, they can invest, but there's a specified limit for that. That means a general overall country limit is prescribed, which is USD 750 million as on date. Earlier it was 500 million. Up to a total of USD 750 million. In total, all the AIFs can deploy these fund in foreign securities, but these securities should be only equity linked instruments of offshore venture undertaking. So it is not that I can invest in any of the securities listed outside. I can only invest in foreign securities which are equity linked instruments of offshore venture undertakings. I have to take prior SEBI approval. So if I have if I propose to invest 10 crores in an outside equity linked instrument, I have to take a prior approval of SEBI, and from date of receipt of this approval, that approval I have to make an investment within 6 months period. Otherwise, that approval will expire. Apart from that, out of my total fund, only 25% of the investable fund I can invest. So it is not that I can invest any amount of my fund, but only up to 25% of my investable fund. Now, what is the role of investors in case of an AIF? How much they govern an AIF? So AIF is pretty relaxed provisions, and except for angel fund, investors are not required to interfere much, but there are certain specific requirements which SEBI has provided, wherein we need to take approval of investors within 3/4 majority or 2/3 majority. So first I'll just take you through where we have requirement of 3/4 majority approval of an investor. First is any material change in the fundamental attributes of the fund. If I am making any change in my fundamental structure, say sponsor is changing, fund manager is changing, I need a 3/4 majority of the my investors. Investment by fund in an associate entity, we have dealt it before. So if the sponsor or the fund manager propose to make investment in an entity which is a related entity wherein I have any interest, I have control or shareholding, then I need to have an approval of my investors with 3/4 majority. In specie, the distribution of funds. So if I am not proposing to distribute the cash, but the assets, or not giving returns in cash, but propose to distribute it, I need to have approval of 3/4 majority. Extension of time limit for valuation from 6 months to 12 months for category 1 and 2. So there's a valuation requirement for the AIFs. If I propose to extend it for a period from 6 months to 12 months, I need a 3/4 majority approval. And then winding up of the fund, I need a majority approval. Then there are, in two cases, I need 2/3 majority approval. One is extension of term of the fund, that is from my minimum period is 3 years, and if I want to extend it, say, to 4 years or 5 years, I need to have an approval of my 2/3 majority. Material change in my investment strategy. So if I said that I would be deploying X percentage in one sector, X percentage in Y percentage in another sector, and if there's a change in my strategy, that has to be approved by 2/3 majority of the investors. What are the reporting requirements? So pretty much not much reportings are required, but certain reportings are definitely required to be done. Some reportings are needed to be done to SEBI, some are to custodian, and custodian will in turn report to SEBI. Then there's evaluation requirements. So quarterly reporting has to be carried out by category 1 and 2 and 3, which do not undertake leverage. Category 3, which takes leverage, they have to make a monthly reporting requirement to SEBI. Custodian has to do the category 3 is also required to have a daily reporting to custodian, and custodian in turn will send it to SEBI by 10 a.m. next day. This is very important to ensure that leverage limits do not exceed the prescribed limits. Category 1 and 2 are required to have a valuation requirement of in every 6 months. Compliance test report. So at end of each year, a trustee is required to carry out a compliance test report of the compliances which an AIF has carried out within 30 days from the end of the financial year. Performance report is to be provided by category 1 and category 2 to its investors within 180 days from the year end, and within 60 days, and for category 3 within 60 days from each quarter. So category 3 is required to have higher degree of compliances. NAV report is also required to be given by the AIF to its investor for category 3 only, open-ended every month, close-ended every quarter. There are 3 latest requirements which SEBI has introduced by various amendments. One is performance benchmarking. It requires that performance benchmarking in order to ensure the investors have a standard to compare the AIF performances. The first report was required to be given by July 2020, but up till the September 19 quarter year. But this requirement has been now extended, and the timelines have extended to October 2020. Audit requirement has also been recently introduced. Now all AIFs have to undertake mandatory half-yearly audit from a chartered accountant or a lawyer. Then there's a stewardship policy which has been introduced. For requirement of having a stewardship policy, these are applicable as of now only to category 3, because SEBI proposes to have the AIFs to play a more known role with respect to decisions which a listed company is making. So they require that, like it is already applicable in insurance sector. So wherein AIFs of category 3 have investments in listed companies, they should be aware of what decision making these listed companies are making, and to have an active role and say in the decision making of those listed companies. So this stewardship policy has also been introduced very recently by SEBI in AIF category 3 segment. Though Mr. Vijay has already briefly covered this taxation aspect, but I'll just state what are the important provisions with respect to taxations in the hand of investors. So category 1 and category 2 enjoys tax pass-through status. Now, when we talk of tax pass-through, no income, no taxation is deducted at in the hands of AIF, but the income which is earned by this by the investors of AIF, in their hand it is taxable. So if I'm a foreign investor, I can get the benefit of my treaty from whichever country I belong to. If an Indian investor, then my income will be taxed at the rate of what my slabs are. Earlier, only tax pass-through status was given with respect to the profits and income, and loss of AIF was not being passed through. But in 2019 amendment, this has also been advanced to category 1 and category 2 investors. Now, any investor who's holding the which is holding the units of AIF for more than 12 months can also take the benefit of losses which has been incurred by this AIF. Category 3 does not enjoy any pass-through status as on date. Its income is generally treated as business income and charged at the marginal rate of tax. There are contentions with respect to capital gains, etc., that whether it has to be taxed at the capital gain rate or as a business income. But also interestingly, category 3, which is registered as trust and has a proper trust deed in place, so those trusts, then in that case the taxation with respect to trust will apply. Also, there was an much needed amendment in taxation in 2019, which provided that the requirement of fair market value and the taxation tax applicability in the hands of recipient if the transaction is carried out at a price higher than fair market value is not applicable to category 1, and now it is also not applicable to category 2. So these are the legal aspects with respect to AIFs, and over to you, sir.
Okay. Thank you, Deepika. Thank you very much for giving the detailed presentation that how AIF can start. Now, AIF has a very important role, that is a custodial role, and then custodial role along with the accounting role. So now I will request Anand to take up that what is the custodial role and how this fund accounting takes place in the AIF process.
Thank you, Pawanji. And I hope I am audible to everyone.
Yes, yeah, you're audible. You carry on, your presentation is visible.
Thank you so much. Thank you so much. So thank you so much for having me here. And there is, I mean, Pawanji and Deepika has covered in detail what the AIF structure looks like and what are the different types of categories. I'll not waste much time, and I'll have a quick practical approach as far as the custodian and a fund accounting role is concerned. So quickly to begin with, I'll just give you an overview on the industry landscape and appointment of custodian. Again, this point Pawanji has covered initially, and I'll quickly touch base upon it. As you can see right now, the investments made stands close to around 1,42,000 crores approximately, and this have seen a massive jump from the last year also. in spite this last 2 years not being so good, especially for the category 3 AIF fund, and primarily related to the equity markets, where the markets have primarily corrected basically. So I'll quickly just give you an idea as to what the growth in the AIF has been from 2012. These are the assets which have grown, and if I am assuming, I don't know what the type of audience is who have logged in here, but just to give you an idea, we are nowhere close to the developed market, and the alternative investment funds have a very long way to go. And if you look from 2012, as I was saying earlier, there has been a CAGR growth of close to around 13 to 15%. This year being an exception because of COVID, but I still feel even on a higher base, we can easily grow conservatively from 10 to 12% over the next 5-6 years. And coming back to the custodian role, what role does a custodian? Why is it necessary to appoint a custodian? So, as Deepika mentioned, for AIF category 3, it is mandatory and it is compulsory to appoint a custodian. And for category 1 and category 2, if the AUM is above 500 crores, then it is mandatory to appoint a custodian. Now, I will just touch base here on AIF category 1 and 2. Although the requirement is above 500 crores, what we have been recently seeing over the last 1 year is that even the smaller AIF category 1 and 2 funds, specifically AIF 1 and 2, even though they are small, and if they have foreign investors investing in their fund, they are appointing the custodian from day one as a good corporate governance practice. I'll elaborate more on this when I explain the role of the custodian. So the recent trend, what we have been seeing and we have been interacting with the clients, is that although the fund size is below 500 crores, they are ready to go ahead and appoint a custodian as a good corporate governance practice. Now, I'll quickly touch base upon the role and the importance of the custodian. Now, this is very important. I have kept it simple, and I'll just quickly run through what is the important role of custodian. Probably people who have logged in and who have been a part of the mutual fund industry are aware as to what is the importance of custodian. But what we've also been seeing, there have been different fund managers. There have been the brokers who are also launching the alternative investment funds, to whom the custodian and the fund accounting activity is new. So I think the next few minutes will help you to have an idea that why it is important. Let me just clarify here that the role of a custodian and the fund accounting is having a fund accountant is having as good as taking away 80% of your work once you get the license and you start with the operations. So keeping in mind, the primary objective of the fund manager or the investment manager is to manage the funds, and he or she should focus on research. And that is where the custodian and the fund, choosing the right custodian and the fund accounting becomes important. And they take away the 80% of the work. What I mean is, I'll quickly cover upon first the role of the custodian. So there are three important roles of custodians. One and the primary most important is to safeguard the assets of the fund and to protect its end investors. Now, when I say assets, what it means that the assets are held by a custodian either in the demat form or in the physical mode. So once an AIF goes live, since it's a collective investment scheme and the investments are made, there's a pool bank account which is open, and there's a pool demat account which is open, in which the investments reside. I mean, investments can also be in a physical mode. The second most important point or the function of a custodian is to do the settlement of the trades. Again, the buying and selling of the transaction. So any transaction, I'm just emphasizing more here on the category 3 because the frequency is much higher. So whenever the category 3 funds, depending on what the strategy is, whether it's a long only fund or basically it does derivatives also, whenever it does the buying and whenever the buying happens, the complete settlement process is handled by the custodian. The fund is allotted a custodian participant code, and that helps the fund to trade with multiple brokers without bothering about who will do the settlement. So it would be primarily the custodian. So if a share is purchased on T-day, the custodian will go ahead and confirm the trade which has happened on the broker with the broker, and on T+1 the payment would be made, and on T+2 the shares would lie in the demat account, which the fund would be able to have access to. As I said earlier, the importance of this is that it helps the fund manager to concentrate on his core function, which is research and investments, and not bother about the operation stuff. And what we have seen is that since most, if you look at the people who start AIF and are very new, the size of the fund is below 100 crores. Eventually, they don't have a large team, and that is where the custodian and a fund accounting helps them. It also boosts the investor confidence, and it helps the fund to market the fund. If you look at globally, although in India it's not that prevalent, but as I said, in the last 1 year, we have seen a lot of clients appointing, especially the category 1 and 2, appointing the custodians, because if there's a foreign client who is investing in your strategy or in your AIF, there will be one question which they would definitely ask, whether you have a custodian on board or not. And that gives us them the confidence that in case something goes wrong, the assets are safeguarded by the custodian. And as I said earlier, it's a good corporate governance practice. From a fund perspective, since the team size is small, it reduces the transaction cost and brings in the overall operational efficiency. Other important role, the third most primary important role, is that all the corporate actions, you name it, right from dividends, right issues, buybacks, split, whatever comes or happens in the stocks, the custodian tracks it and reports it to the fund. And what Deepika also mentioned, the recent change which has happened with the stewardship policy, which has become applicable to AIFs also. AIFs would also require now basically to compulsory participate in the proxy voting, and that is where fund accounting can help them. And as I said, that one of the compulsory, if it's compulsory for AIF category 3 to appoint a custodian, so you're meeting the SEBI regulations also. And again, Deepika mentioned the investment criteria, or what are the instruments in which the AIF can invest. If suppose the funds are lying idle and the investment manager needs to park that fund in the liquid funds for some time, for short duration, it is done by the custodian. So that is also not the headache of the fund manager, that he needs to go ahead and park it and again redeem it. So all this settlement of transactions is taken care by the custodian. And we are seeing that from what is happening eventually in the market, taking into the custodian role will become much wider. Just to give you an idea, if some of you guys who have logged in, or some of the participants who already also have a PMS or who know the PMS regulations earlier, in PMS also it was not compulsory to appoint a custodian below 500 crores. The point I'm trying to make here is that what we also foresee, that going forward it might also happen that for category 1 and category 2, this could be done away with. As I said, there are various advantages of having a custodian going forward. So this could very well come going forward, and it is always better to have a custodian from day one. Coming back to the role of fund accounting, now in simple terms, what is fund accounting? Fund accounting is an accountant which does the accounting of transactions on behalf of the fund for their investors, for their end investors. So whenever the stock is bought, whenever the stock is sold, or for Cat 1, Cat 2, whenever the investments are made, there is certain reporting which needs to be done to the investors. That investor, I mean, it could be a statement of account which could be given by the fund to the client, where in the details would be provided that what was the commitment made, what was the commitment made by, what is the investments made, what are different type of investments, what is the value, and what is the net asset value at the end of the month, or basically at the end of the period which the AIF plans to disclose it or give it to their end clients. So simply put, it does the accounting and recording of all the transactions, and these transactions could be the equity transactions, fixed income, mutual funds, derivatives, etc. Plus, it gives the fund level reporting. So basically, in AIF, since it's a pooling investment vehicle, it starts with an NAV. So suppose if, for example, if the NAV is 10 or rupees 100, the fund has started, the fund performance is shown by the NAV over a period of time, which is provided by the fund accountant. So the performance reporting to the investors is also provided by the fund accountant. And apart from not only just the reporting part, but the important aspects which Deepika mentioned, which needs to be provided to the investors, like booking or the calculation of fees or recording of expenses, all this is done by the fund accountant. And the fund can have the monthly, quarterly, or the half-yearly SEBI reporting. For AIF category 3, it's basically monthly, and fund accountant does a great value add. Is to simply put, fund accountant is the backbone for AIF category 3 and also plays an important role in AIF category 1 and 2. Why I say that? Because category AIF 3 can have complex trading strategies, which a good fund accounting team can understand, and obviously help in reporting it to proper reporting to the investors, so that the investors understand how the returns have been computed and what are the different implications. Even the calculation of the capital gain, the performance fee calculation, and any reconciliation which has to be done with the bank balances is done by the fund accountant. So in summary, the reporting of the transactions to the investors, to the fund, is provided by the fund accountant. Not only this, there is a monthly SEBI requirement that the AIF should have, that there is certain reporting which needs to be done to the regulator, which is SEBI, and the data which needs to be provided once a fund accounting is appointed is given by them. So all they need to do is just upload that file on the SEBI website, and that headache is also taken care of. So as I said that in the beginning, 80% of the operational work of an AIF, once they have a custodian and the fund accounting, is addressed, and that gives a big relief to the investment manager, so that they can focus on the core activity. I have quickly just highlighted here in the roles and responsibilities with respect to the AIF life cycle, because AIF would use a broker to execute a trade. In case if it's a category 3 AIF, they would require a custodian. Obviously, they would have clients, they would have appointed a legal advisor, would have helped them draft and make an application, and they would have a trustee also. So I will just quickly cover from a custodian and client point of view. The KYC of the AIF is done by the custodian. The demat account, the bank account, the custodian participant code is given by the custodian. The compliance part is also taken care by the fund accountant, as I mentioned. When I mention here the trade life cycle, what I mentioned here is the settlement of the transaction, which happens on the stock exchange, and also the regulatory reporting. So you can see what aspects are covered by a custodian, and this is on an ongoing basis till the life cycle of the fund. I will just quickly show you a trade flow. This is simply put, a client instruction comes, the matching of the trades is done, the confirmation of the trades is done on the T day, which is the trading day, and the early paying of the funds is done to the exchange on T+1. And the payout of the funds or the securities on T+2 is done, depending whether it's a buy transaction or a sell transaction, and then the end client reporting happens. So I have summed up myself with this, and this was a short presentation showing the importance of the custodian fund accounting. I'd be more than happy to answer your questions at the end of the presentation if you have any queries on the same. Thank you so much.
Thank you, Mr. Anand. Now, now we have a very learned speaker of this session, Mr. Arvind Mathur. As I told you, Mr. Mathur was a part of the committee, and he has in and outs of this AIF. So I will request Mr. Mathur to share his viewpoint, the questions which I have shared with you, and your own thing relating to this AIF. Because I have given overview, Deepika has tell the legal part. Now you give the market and the point of view of the AIF part and the investor part, because you are in this field. So please, over to you, Mr. Mathur.
Thank you, Pavan. I think this is a really nice and interesting webinar. The topic is close to my heart. I've spent almost 30 years of my life in this field of private equity, venture capital, and AIFs. So I would try not to repeat what has been said. I will try not to repeat. So I'm going to talk about 4 or 5 things. I'm going to talk about the AIF regulations. What are the principles of the AIF regulation which make it a very sound regulation. I'm then going to talk about the kind of regulation that SEBI does. Apart from the rules, what is their approach and mentality? I'm going to touch upon some of the major tax issues that have been encountered. I'm going to address the issue of foreign investors, whether they like to come into an Indian AIF or whether they would like to invest directly from a fund established offshore in a place like Singapore or Mauritius or elsewhere. So I will touch on that foreign element versus domestic element. And finally, some of the key reforms that have already been done and some of the reform that are still needed. So I'm coming with a very positive mindset towards this industry, the alternative investment fund industry. As has already been said, that the 1996 regulation of venture capital was repealed by SEBI in 2012 when they enacted the SEBI Alternative Investment Funds 2012 regulations. Now, without going into specific regulations, what are the principles that attract me to this industry because of the presence of this regime? And I'm really looking at it from the standpoint of an investor. An investor in an AIF, you can call him an investor, you can call the person a contributor, and what is more common in international parlance is they're called limited partners. So when I worked at the Asian Development Bank, I was acting as a limited partner, and in some respects we were also like a fund manager, which was a general partner. Now, what are the attractive features that give confidence to the investor? AIF regulations 2012 give confidence to the investor to invest in this asset class. First and foremost, SEBI has enshrined the principle of the fiduciary responsibility of the fund manager. The fund manager is managing this fund not in his interest, but in the interest of the investors in their fund. That is the first priority. He has to keep in mind that the interests of the LPs, the investors, the contributors comes ahead of his own interest. To me, that's a big thing. For LPs, that's a big thing. Conflicts of interest. This means conflicts of interest have to be disclosed. There's a way to manage the conflicts, and it keeps the fund manager on his toes. The other very good feature of this scheme is the mandatory rule that SEBI has included in the regime, which is what's normally called skin in the game. Skin in the game is the investment, or rather the fund manager has to put his own capital into the fund. The idea is that if you're managing somebody else's money, you will be careless. You'll be careless, you'll make mistakes, you will lose money. But if you have your own capital in the fund, then the chances are that you're going to be more careful. So an international practice in the private equity and venture capital industry since the 80s around the world, in the United States, etc., has been what this is called skin in the game. And SEBI, under the AIF regulations 2012, made it mandatory that for any AIF, the fund manager has to have his own money invested in the fund. It can come in parallel with the investment by other investors. So what is this skin in the game? For every fund, in every fund sponsored by a fund manager, he has to put 2.5% of the fund size from his own pocket, his own money, or 5 crores, whichever is less. That's the rule. These are for AIF category 1 and AIF category 2. AIF category 3 has a different skin in the game requirement, which is 5% of the fund size or 10%. Sorry, minimum of 5 crores or 10% of fund size, whichever is less. So this ensures that the fund manager has sufficient skin in the game, meaning his own money is invested. The requirements of AIF category 3 are exactly double the requirements, the minimum investment requirement by the manager of AIF 1 and 2. So that's the first thing that I'd like to bring up. The second is, and all this gives confidence. The reason why this is required, the reason why the SEBI has this rule is this gives confidence to the LPs, to the investor, to the contributor. Of course, SEBI also has a scheme whereby, or rather also requires that the fund manager has experience of investing in the type of investments made by an AIF. The other thing that you would have noticed, I think everybody would agree with me, at least this is my observation, is that the rules are so good and they are so watertight that SEBI has had what is called light regulation. It is not an invasive regulation. It is not, there hasn't been really a need for very invasive, hard regulation. It's called, SEBI has had a light regulation. You must be reading every day about RBI giving orders to banks, do this with your NPA, do that with the NPA, cases between banks and RBI going to the Supreme Court. You would have noticed all that. I'm not saying that is not required. That is definitely required. But in this industry, the AIF industry is so well regulated, the rules are so good that if you are compliant with those rules, if you genuinely believe in them, genuinely comply with those rules, SEBI doesn't have to come and interfere with your business. So to me, all of this makes the AIF capital product a very attractive vehicle for investors to channel their capital. So that's one aspect. These are 2-3 strengths, I would say, of the AIF asset class. And there's one more which I'd like to mention, I'm not sure whether it was stated, is the concept of closed-end funds, which all of you know because there are mutual funds which are closed-end mutual funds. You have open-ended mutual funds, closed-end mutual funds. But in the case of private equity and AIFs, the concept of closed-end is supreme. Private equity funds, AIFs, venture capital funds, these are closed-ended. Once you raise, let's say 100 crores of corpus, 500 crores of corpus, 7,000 crore, whatever amount of money you mobilize, you have that capital with you for, let's say, 7 years, 10 years. If it's an infrastructure fund, it could be 12 years. So the beauty of this is that it's long-term capital. When you're going to invest in a company, which when a mutual fund invests in a company, it can enter today, exit tomorrow, which is fine. That's the model for mutual funds, but not in the case of AIFs. In the case of AIFs, you mobilize capital, you invest that capital, you're not in no hurry to invest the capital. You're given 4 or 5 years to invest the capital. And in these 4 or 5 years, you find good investments, you do your due diligence, there's no hurry. And then steadily exit the investments over the life of the fund, which is 7 to 10 years. Now, what's the beauty of this? The beauty of this is that Rome was not built in a day. If you're going to invest in a company, it takes time for the company to grow, to capture its markets, to improve its products. The company requires value addition by the entrepreneur. And if all of this is done well, the company will succeed. And this takes 3, 4, 5 years of time, maybe 6 years. So that is the model of category 1 and category 2 AIFs. They are long-term investors with capital that is locked in. And this capital that's locked in, the government loves it. The investor love it. When I was at ADB, the only way we could champion this with everybody was, hey, look, we are giving capital for the long term, for long-term investments. We are mobilizing capital from CDPQ, from CalPERS, from whoever, GIC Singapore, Abu Dhabi Investment Authority, on a long-term basis for an investment fund, which will have a life where the fund is closed for 10 years. And our board would love it. So the investor loves it, the board loves it, and the companies love it. The portfolio company that receives the capital from an AIF loves it, because they have long-term capital, patient capital, which will give them time to build their business. So this feature of stable long-term capital associated with closed-end funds is really appreciated by the government. So here I'd just like to transition into a related topic. What SEBI did, I mean, my experience with SEBI has been excellent. We had lots of discussions with SEBI, fund managers. I used to work in the IVCA, plus when I was at the Asian Development Bank, talked to a lot of people, including SEBI. And SEBI had a very open mind. And if we had to justify something to SEBI, that's, dear SEBI, dear Mr. Sinha, dear Mr. Ajay Tyagi, you know, whoever were the chairman of SEBI those different days, and the lovely officers of SEBI, how would we justify a reform? We would say, look, we are bringing in long-term capital. If you bring this reform, you will get more long-term capital. We are bringing in capital where there's going to be strict governance norms. Once you could say that, and finally, that is going to benefit the country, because we're going to develop projects. This is not for trading purposes. An AIF category 1 and 2 doesn't invest for trading purposes. It's investing for the long haul. When we would talk in this language, that this is our psychology, we are investors, this is our psychology, you know, SEBI would listen to us. And SEBI brought so many reforms, right from 1996 till today. SEBI is always thinking of reform. So they had set up a committee called the Alternative Investment Policy Advisory Committee, chaired by Mr. Narayan Murthy, chairman of Infosys. He chaired this committee, and this is one of their reports that I had with me. And in these 3 reports we wrote, in these 3 reports, we came out with a lot of suggestions. SEBI gave us a very fair hearing. We discussed with a lot of other fund managers before we made any recommendation. SEBI heard us. We presented it to Mr. Jaitley in the finance ministry, to the officers in the finance ministry, to the tax department, to CBDT, all of these people. We got a very receptive audience with these people. And many of the reforms were brought in. So why am I saying this? I'm saying it that SEBI has the right mentality, the right attitude. It's not that they want to help you. That's not the reason. The reason they want to promote this industry is because it is a long-term, stable capital that only works where the fund manager has the highest standards of governance, and he's bound by that under SEBI regulations of AIF 2012. So that's a couple of comments on SEBI and AIF regulations. The beauty is, as Pawan Sahab just mentioned in the beginning, Pawan Sahab showed data that said that the number of AIFs registered with SEBI is something like 818 today. And I was looking at some old data of 2018, there were 400. Can you imagine the growth? From 400, it's gone to 818 AIFs. And this is the beauty of India. India has fantastic growth prospects, in my view. I mean, we Indians, we're always criticizing ourselves, our country, and this and that. The fact of the matter is that the underlying dynamics of this society, this country, are very strong. And that's shown in the numbers. 400 AIFs in 2018, 818 now. It's unimaginable development. And I'm not trying to say that I'm trying to boast about India. Other countries have done it already. United States, Europe, other countries, a similar phenomenon has occurred. Now, I would just like to touch upon some of the one particular issue, which is faced by foreign investors. And that issue is that should you, as the foreign investor, foreign contributor, limited partner, whatever you called, invest in a fund that is registered in Singapore or Mauritius or Cyprus, or should you invest one in India? This is an issue. And one of the things that SEBI has been trying to do is SEBI has been formulating its rules and regulations that makes India attractive for these for these investors to invest directly in AIFs which have been registered with SEBI in India. And this is laudatory. I think this is great. But having said that, there are a couple of pros and cons. Now, one particular model is that you have created domestic fund within India registered with SEBI, and a foreign investor invests directly into it. That is quite uncommon. The other model is that you have a domestic AIF in India registered with SEBI, and the Indian fund manager opens at an international jurisdiction, a private equity fund or a AIF in, say, Mauritius or Singapore, and that's called a feeder fund. And the foreign LP is going to invest like the Asian Development Bank, the IFCs, the CalPERS, the CDPQs of the world. They're going to invest in that international feeder fund set up in, let's say, a jurisdiction like Singapore. And through that vehicle, the investment flow will flow into the Indian domestic AIF. That's the second model. And the third is, and this second model is happening. I mean, quite a lot of these funds have been structured. It's called the unified model. One fund abroad in Singapore or Mauritius or somewhere, and one fund domestically here in AIF, and the fund abroad invests through the domestic AIF, managed by one common manager. This is quite common and has happened and is happening all the time. And the third model is where there is no domestic AIF at all. The fund is simply set up in Mauritius or in Singapore, taking advantage of the double tax avoidance treaty and investing directly into Indian corporates wherever there's a decent opportunity. So the debate is between the third model, where you don't need a domestic AIF for the foreign investor, versus the second model where you do have a domestic AIF. Now, so just before this conversation that Pavan Saab kindly invited me to, I spoke to some large fund manager. I think I spoke to one fund manager managing $4 billion in India, and they have not set up a domestic AIF. They have just set up a fund in Mauritius or Singapore. They've set up a number of them over the last 20 years, and they have they invest directly from there into India. So he said there was no tax disadvantage that they felt. They felt that the capital gains tax that an Indian AIF or an investor investing through an AIF has to pay is 10%, while under the double tax treaties, it's also 10%. So they found no particular reason. The other thing is that people are not, see, when you're a foreign LP and sitting out of Alaska or in Canada or wherever, United States, all of these are very conservative organizations. Remember, somebody dealing with billions of dollars has to be very conservative. So they're used to a particular model. If they're used to saying, you know, I'm going to invest through Cayman Islands, through Mauritius, and then directly into their portfolio company, that's what they're used to, then they will do it that way. They're very conservative. They're not yet familiar with the SEBI's AIF regulations. There are naturally, India, at the end of the day, we are an emerging market, we're a developing country. Sometimes laws change, regulations change, and there's instability in the regulatory framework. We have an annual budget cycle. Chidambaram Sahab comes and he takes away the, he removes the fiscal neutrality of funds. So the regulatory framework has to be steady. For the foreign investor to gain more and more confidence in our country, the regulatory framework should remain steady. So if today we say, look, we have a regime where we have a tax pass-through provided by the 2015 budget, union budget, then we must keep it forever. So for these sorts of reasons, there are a number of funds who are set up in Singapore or Cyprus or Mauritius, and they invest directly into Indian companies. And India welcomes that. Why? Because that's long-term capital. These are very respected investors. They would be the pension fund in the state of Ohio. There would be a sovereign wealth fund from Abu Dhabi. These are very respected investors. So some of them will, but many are open-minded. They say, fine, we will go through a domestic AIF as well. So it's not as though it's a no-no, a domestic AIF. But I do want to share with you that there are several private equity funds that do not have or don't feel the need for a domestic AIF. But I'll give you one more rationale why a domestic AIF is a good thing for a foreign investor. So one of the features that gives confidence to the foreign investor or the foreign LP is that if there are local investors involved. So if you're a pension fund of state of Washington, Seattle, you want to say, look, I'm sitting in Seattle. What do I know about India? Yes, I've got a lot of capital. I'm willing to invest $50 million. This India fund has got a good track record. I'm willing to do that. But hey, there's no Indian investor in this. To me, I don't feel happy about that. I want to see some Indian investors because you want some local investors to have skin in the game. So some LPs would be quite happy with that. So there are pros and cons for foreign LPs to invest in a fund in a unified structure. Unified structure means a domestic AIF plus an offshore fund, which is the feeder vehicle, or just a fund based overseas and investing directly into Indian corporates. So those are the thoughts I thought I would share on domestic versus foreign jurisdictions for foreign investors. Now, I would like to touch upon some reform that are still needed. One of the major reforms, so by the way, we did this 2000 and, we did this 3 copies, 3 reports like this. This is one. We did 3 big fat reports like this for SEBI. There were lots of recommendations. Now, one of the recommendations that was made. And Sri Jayant Sinha accepted that recommendation. And he kindly put out a memo, was to PFRDA. Now look, today, I believe PFRDA is managing about, in local currency, $60 billion. None of this is going into private equity, Cat 1 and Cat 2 AIFs, is my understanding. If I'm wrong, please let me know. Now that's a huge pool of capital. So one of the latest recommendations, so we made this recommendation in the APAC report, was that domestic institutions should be encouraged to invest. Now, one of the problems in the AIF industry, private equity industry, is that, when you open the newspaper every day, KKR invests 300 million, Carlyle invests 1 billion, you see Goldman Sachs investing 1 billion. Well, you're not seeing Indian names, you're seeing foreign names. Even now in the big Reliance platforms, all the investors are international. So what is the problem? It's a big problem. We have 80 to 90% of the capital coming in to India, which is long-term private equity patient capital, is coming from overseas. And the same problem existed in Korea, Thailand, Indonesia, everywhere, because the capital markets abroad are huge. Those are very wealthy countries. But look, India is not smaller. In India, for example, you have a lot of domestic insurance companies. They have long-term patient capital. You have PFRDA, which has $65 billion, I believe, of assets under management in different schemes of PFRDA. So a recommendation was made that PFRDA should be allocating 1% of its total AUM into AIFs 1 and 2, into private equity funds, venture capital funds, etc. But this has not yet happened. Now, we really need this to happen because, look, foreign investors, one day they're here, one day they're not here. I wouldn't even put it that way. I don't want to look at it negatively. By bringing in domestic capital, you're going to have more stability in the markets. Foreign exchange, so when a domestic pension fund will sell an investment and make a profit of, say, $1 billion, they're not going to take out the money from the country of FX remittance. It will be just kept within India. So there is a strong rationale that domestic insurance companies, domestic pension funds, PFRDA need to kindly consider this asset class and find a way to structure their investment allocations such that at least 1% can be allocated. And over time, this can be increased to 2, 3, 4, 5%, maybe in 5 years' time. So that is one recommendation that we have made, and that has not yet happened. Recently, I read that a recommendation has been made that AIFs should be allowed to invest in NBFCs. This was a recommendation that has been being made from a long time, and it has been repeated again to the government. And now you can see the need for it. If you look at NBFCs today, many of them have faced stress, and many of them would have good managers, good credit policies, but there's lack of capital. So a recommendation has gone to the government that, look, kindly allow AIFs to invest in NBFCs. This recommendation, I don't think, has yet been implemented. And then, of course, there were other recommendations we made to attract foreign capital into India was to the gift city. In gift city, we recommended that it should be made as attractive as Mauritius or Singapore, so that if I'm a foreign fund manager, instead of setting up my fund in Singapore or Mauritius, I should set it up in the gift city zone. And all the benefits that they get in Singapore or Mauritius, you give them here in gift city. That will be good for our ecosystem. So we made that recommendation. SEBI bought into it, and SEBI passed further regulations to promote AIFs in the gift city. So Vijay, you can stop me anytime you like.
Yes, sir. I have just, because there are some few questions that come, so I will take your time. So because the people have asked a few questions, so what I'll request you, I'm raising these questions which I have received, and anyone can give answer wherever, because some technical questions, so Deepika can answer, some general question you can add, and some question which is Deepika is giving and you want to add, you can add. So I'm just taking a faster question, and Deepika, we have to very short, okay, because presentation of all three and Mr. Mathur has covered everything. What did mean by category 1, 2, 3 or AIF, that we have already covered. Okay, we have explained in both the things. Our alternative investment fund is a better choice compared to normal mutual fund in terms of tax saving. Mr. Mathur, can you suggest this?
Yeah, when you repeat the question, please.
Our alternate AIF is better choice comparing to normal mutual fund in terms of tax saving?
Well, I think both of them are subject to pass through. So
okay.
I would make that immediate comment. Beyond that, I don't know what the benefit would be.
Sir, mutual funds have a little better tax structure, but both are not comparable in the sense that AIFs are for HNIs and mutual fund is more for the retail investor.
Okay. Whether LLP require any approval to register AIF prior to incorporation?
Yes, LLP deed has to be registered. LLP need to be incorporated, and then you have.
For incorporation.
Then you will go first. Yes, for incorporation.
No, ROC, when you register LLP, then you require any approval?
No, at the time, we have to register LLP keeping in mind the requirements of law. That is, they should be restricting this raising of fund from public and also have an object of AIF.
Okay, are the corpus required at the AIF level or at the scheme level?
Scheme level. Each scheme has to be of a 20 crore corpus.
Okay. How do we pay the fee to manager of fund? Will they that be from corpus of fund, or it shall be paid from earning from the invested project?
That there is no sir can add to it, but there is no legal restriction. Whatever they are doing, they have to disclose in the PPM, private placement memorandum.
Okay, on the fee, I'd make a quick comment. The fee is payable from the fund's corpus. Now, the fund's corpus, keeps adding because of the profits and gains made by the fund, but it is payable from the corpus. It has to be fully disclosed in the accounts, and that's how it is paid.
Okay. Deepika, how much the AIF preferred trust structure than company, LLP, body corporate?
So trust has a much lesser compliances. Confidentiality is more. So that is why, and trust is a widely accepted form all around the world. Foreign investor is also more familiar with the trust route for fund structuring. That is why trust is preferred.
Okay, I'm now on a rapid fire round. Okay, because time is short. So, are there any requirement to also register each scheme?
Yes, each scheme has to be registered. 1 lakh fees is there. Each scheme has to be registered.
Can a fund pay the referral fee to mobilize the fund from investor? If yes, there any cap on such fees, sir? Mathur?
Yes, they can. They can pay,
Okay.
and they have to be has to be disclosed in the information memorandum.
Okay. Is AIF an example of CIS?
No, both are just pool of fund, but very different.
Okay. Whether AIF can invest in projects run by partnership firm or proprietors concern? If so, who has power to look at the viability of such projects?
So AIF is essentially a tool which allows investment in securities. Partnership, project is not. There are no insecurities there, so they cannot allow there. They cannot make investments in that.
Okay, Mr. Mathur, why do category 3 fund not have pass-through benefit when it comes to taxation?
Yeah, so this is a very good question. Now, a lot of people, including IBCA, have been recommending to SEBI and to the Ministry of Finance and the CBDT, etc., that the concept of a pooled vehicle, is that it has to be tax transparent. Pooling is just a convenience. So the tax has to be not on the pooling vehicle, it has to be on the investor. So we made the case that, look, whether you're category 1, 2, or 3, it's the same concept, and therefore there should be passed through for AIF Cat 3. Now, the reason why it hasn't happened is that the government, hasn't been able to get its arms around AIF 3. We have to convince the government what are the benefits of Cat 3 to the Indian economy, to the society of India. Until we can make that case very strongly, what are the benefits to the capital markets? Then they will be say, all right, they think of it as though we are giving you some tax concession. An AIF, tax transparency is not concession. So
okay,
it's to avoid double taxation. So that must be stopped, but it hasn't been done.
Okay. Anand, Deepika, how much time it takes to or should get funded from equity fund? Usually we hear fund takes more than 3 to 6 months.
Sir, it depends from fund to fund and their investment raising capacity, how good they are, how good the managers are.
Okay, Anand.
Also, depends on the
yes, Pawan.
Anand, there has been a huge wave of P and VC fund in the last decade, but now the steam is losing. Do you feel COVID-19 may further damage the prospects of AIF?
No, I don't think so. The challenge is primarily what we have been interacting is from raising the investments. That could take, that is taking a hit for quite some time, as we know that everyone has got affected and the activities have slowed down considerably. But I think as we get back to normal by December, I think things should pick up again.
Okay, Mr. Mathur, in case of fund AIF is pass-through is available to both funds.
Yeah, it's available to both, is my understanding.
Okay.
There's no. If you look at I think the Income Tax Act, there's no mention that it's not available to fund of funds. It just says Cat 1 and Cat 2.
Okay. Anand, I'm asking, in case investment in liquid asset, how investor can get back prematurely, although scheme mentions such redemption? What is the meaning of fair value when it is illiquid investment?
So usually, Pawanji, if I understood the question correctly, usually the idle funds, when there are no investment opportunities or till the time the investments are done, those idle funds are parked by the investment manager to optimize the returns for the clients. So ideally what we have seen is where the fund managers invest is basically the overnight funds or the ultra liquid funds or the liquid funds. So these are primarily the investments. Apart from that, we've also seen clients investing in FDs. So we have not come across, unless and until there's a category 2 fund, which is a debt fund and has taken exposure to the high credit risk funds. Most of the guys played safe and invest in either FDs or basically liquid funds.
Okay, Mr. Mathur, can AIF close abruptly as recently Franklin Templeton Mutual Fund closed its 6th debt fund? And if yes, whose door investor will knock for AIF?
No, it's a very different concept. AIFs don't close down like the way some of the mutual funds, are shut down. They are long-term vehicles. Everyone knows that. LP knows that. They'll go on for their entire life. So if there is a problem in the fund, it will not be closed down. It will be given over to a new manager.
Absolutely.
And in any case, for such regulations also provide that you need the approval of investor,
normal,
majority investor,
for
winding up.
I'm sorry?
For winding up,
Yeah,
regulations
winding up,
also provide that you need approval of investors. 75% of the investors need to approve that.
Yeah, but this is very, very rare.
Every scheme of PMS need to be registered with SEBI?
Yes, they are. We have already taken that question.
Okay. Is an AIF permitted to make investment to the public to subscribe to its securities?
No, they're not. It has to be private placement.
Okay. Whether alternative investment fund registered with SEBI can invest in foreign securities?
Yes, as per the limit prescribed and with prior approval of SEBI.
Okay. Whether AIF can accept investment from joint ventures?
Yes, they can accept from joint ventures.
Only this rapid round, so don't explain. Okay. Whether liberalized limited scheme limit is applicable to AIF? LRS
No, it is not. No, it is not applicable.
Okay, Anand, whether AIF can obtain investment from foreign investor in NI?
Yes, there is no restriction on that, and Deepika can add to it and confirm to it.
No restrictions.
Okay. Whether foreign investor would get tax treaty tax benefit if it is invest in AIF?
Category 1 and 2, because of pass-through, yes. Sir can add further to it.
And 3?
Yeah, all the benefits, all the tax treaty benefits will be available.
Okay. Can it be said that investment in AIF are more beneficial than mutual fund? Sir, Mr. Mathur.
You know what? It's a different asset class. Yeah, it's not comparable. It's comparing apples with oranges. You're trying to compare a Maruti car with a Mercedes Benz. It cannot be compared.
Deepika, whether the category 2 restricted from investing in listed company?
No, they are not restricted. Majority should be unlisted, but anything over 49%, up to 49 is allowed.
So 49% I can invest in a
yes, enlisted.
Whether investment in commodity derivatives allowed?
Yes, it is allowed as subject to certain restrictions.
1 and 2 or 3?
In 3, only in 3.
Okay. I want to invest in my real estate project. Can I launch an AIF to raise fund?
Not directly in the project. There has to be security. There has to be SPV.
Okay. Can I create a? Yeah,
related. Related party. It's a very big no-no. So you have to be very careful. Raising AIF just for investing in your own project.
Okay. Very nice. Achha, I have 5 more last questions, but very small question. Can I create an AIF for making investment in my own entities?
Sir has already answered that. You have to be very careful and approval is needed. SEBI approval, investor approval is needed, yes.
Okay. Whether AIF launch multiple scheme, Anand?
Yes, they can launch multiple schemes.
Okay. Can Anand, open-ended scheme be converted into close-ended? And vis-a-vis?
So I will let Deepika answer that.
Deepika, can open?
No, sir, it is not allowed.
Achha, how does the angel?
Correct me if I am wrong. If an open-ended AIF wants to launch a closed-ended, they have to launch a separate AIF. Is that correct?
Right, you are right.
Okay. Whether AIF can consist only of foreign investors, is it allowed?
Yes, it is allowed.
Sir, any point in this when all the foreign investors are there, no Indian investor?
No. See, there's no objection to that, because if the fund manager is Indian, for example, then there will be at least that one investor will be there. But there's no mandatory requirement for a domestic investor. The government, SEBI is very happy actually.
Okay, last 2 questions. Whether the sponsor of investment management entity of the AIF be the same individual entity? Deepika?
Yes, they can be. Sponsor and manager can be same also. No restriction.
And can be different also. Can be different also.
Can be different also, yes.
whether there are certain minimum qualification to be sponsor of AIF?
Not for the sponsor, but for the manager.
So what is the fit and proper person requirement is there?
He has to be fit and proper. Fit and proper is mandatory for all all three: fund, sponsor, and manager.
Okay, I think I have given all the answer despite of we have overshooted. Last question I have received is SEBI's investment advisor regulation is applicable to manager of AIF as well?
No, they are all together different regulations. They are not applicable to AIF.
Mr. Mathur, the last question. So we have received 30-40 questions. So we have received we have given the answer of last question also. So friends, we have already overshooted the time, and as we are focusing on more questions, so that's why we have tried to give all answers which we have received, and I am successfully completing all the questions which last question which I have received, I have given answer. So I have to just close here because and I want to thank Mr. Arvind Mathur, Mr. Anand for this very nice presentation they have given, and they have given insight because this is a technical topic. It's not a legal only. It's a technical topic, legal, which has a market and which has a the overall economic aspects also. So I thank all the speakers, those who have given their valuable time, and the most important thanks to the participants, those who have come, because it's a very technical and very specified topic, special this topic. So thank you all of you. As you are aware that on each Friday we are having a webinar on different topics, and that we want to continue. So on next Friday, 7th August, we are having a program on income tax, deemed income and deemed dividend, section 56 and deemed dividend. And Mr. Amit Mohan Govil, the income tax commissioner, and Meeta Singh, she's also IRS, and Rakesh Gupta and R.K. Agarwal, our partner, they will address, and there is a very so many issues in the deemed income and deemed dividend that we will cover in this. After that, on 14th August 14th August Friday, Mr. Sahu is coming, and we are having a program on insolvency, the new future era of insolvency, that is 14th August, one day before our Independence Day. And on next Friday, 21st August, we are having a Consumer Protection Act program, and then on the next Friday, that is 28th August, we have a program on valuation, and we have invited the valuer organizations, Mr. Pawan Kumar, who is the IRS, who is the executive director. And then on 4th September, we are having a producer company program. So these are the 5 programs which are lined up, and these programs are all topical and important topics, important subject. We will do it. So thank you very much once again to Mr. Mathur, Mr. Arvind, Mr. Anand, Deepika, and everybody, and all the participants. Thank you very much. We have given the answer of all queries. In case any queries is left out, please send it to us. We will give reply to you. And we have sent the one survey also. Please fill this so we can have better program on the basis of your choice and your requirement. Thank you very much to all. Thank you. Thank you all. Thank you.
Thank you. Thank you, everyone.
No, bye-bye. Bye-bye.
Bye.